As Connie said, I'm Jordan Bergkamp. I am a partner here at Blackwell. I am based in the Kansas City office. Brief background on me: I studied accounting and finance in undergrad. Graduated from undergrad, went to work here at a big four accounting firm in Kansas City doing taxes. After about a year and a half of that, kind of realized I liked the law part of taxes better than the accounting tax return part of taxes, and decided I wanted to go to law school and be a tax lawyer, right? And so went to law school, graduated law school, and became an estate planning attorney, actually, which is, that's in taxes too. Did that for a couple of years, and then I got recruited to move over here to Hush. That's been about 6 years ago. So now I'm putting it all together in employee benefits, taxes, all of my background, helping startups, as Connie said, incentivize people, attract people. And so that's what I'm here today to speak on. And so the first thing I want to say and point out, and it's really in the title of the presentation, the fun stuff, because employee benefits, contrary to what you might think, are fun, right? Talking about compensation is fun, and not to demean my colleagues, my labor employment colleagues, or anyone like who wants to talk about firing employees. We want to talk about attracting talented people and how we can compensate them. So that's the first takeaway I want you to walk away with today. That remember, employee benefits are fun, and I enjoy employee benefits because of that, because it's that part of it is rewarding. Setting up, whether you're at the startup stage or you're an established company, right? How you compensate your employees is a big part of how we can motivate them. But specifically at the startup stage, though, which is what today's presentation is kind of focused on, there are really two main takeaways. I'm going to get into the substance of stuff, but really two main takeaways that I want you to walk away with today. And the first one is that employee benefits are cheaper and more accessible than you may think as a startup. And one of the main reasons for that, and I'll have it on the next slide, is I have a tax illustration, but the tax code incentivizes employers to offer employees benefits, right? Health insurance, retirement plans. The tax code incentivizes both you as employer or potential employer. You may not quite be at the stage where you're hiring employees, but these are things to be thinking of, right? The tax code incentivizes employers and employees to save for retirement, to contribute to health plans, all of that. And then the second takeaway I have, and this isn't to scare you or by any stretch of the imagination, but corporate hygiene is important. So if you're going to be offering, for example, stock options, right, equity compensation, and you don't document it correctly, or you don't keep track of them correctly, and then you have a potential investor coming in, they have people like me and my fellow colleagues that are going to dive into these records, and we're going to find anything that we can find that help drive down the purchase price. So corporate hygiene is important, but don't let that get into the way of offering employee benefits, right? Because like I said, employee benefits are fun, they're great. They're a way that you can set yourself apart in a competitive market, right? We're in a competitive market. We're in the great resignation. People are changing jobs all the time right now. It helps with employee retention. Like if you're motivating them, you're compensating them, they're going to stay. And just from a macro point of view, a healthy and financially stable employee workforce is good for your business. You want them to be motivated, right? You want them to be financially stable. You don't want them to be worrying about other things outside of work. And then the final thing is the tax advantages, and I'll get to that slide here. And what this is illustrating is the first column with the heading paid all in cash. What that's getting at is, let's say you have a budget to pay your employee $40,000. And that first column is you're paying your employee $40,000 straight cash, no tax favored employee benefits. So their entire taxable compensation is $40,000. Let's just illustration purposes only. Let's assume they have a tax rate of 30%. That means they're going to pay taxes of $12,000, and so their take home after tax take home is $28,000, right? And then they don't even get to pay. Then they have to get, if they want health insurance, they still have to go pay it now with after tax dollars. The next column over is an illustration of how just $3,000 worth of tax favored benefits and what that changes for this employee. So you still have, it's still $40,000. Your budget is $40,000, but of that $40,000, you're using $3,000, let's say, for a health reimbursement arrangement that I'll get to in the next slide. You're using $3,000 for a health reimbursement arrangement. Those $3,000 are not going to be taxed to the employee. Go down to the next line. Taxable compensation of this employee is now $37,000. At 30%, they pay taxes of $11,100. Their net take home, including the $3,000 that you're giving them that's not taxed, is $28,900. So $900 more dollars to the employee. Your outlay is still the same, right? $40,000. Your budgeted cost of this employee hasn't changed, but by offering a tax favored benefit, and now they have some health coverage and they have more take home pay. So that's one of the main key takeaways I want you to walk away from here, right? That tax favored benefits are cheaper and more accessible than you may think. First, well, before I get into the substance, there's going to be three main categories that I'm going to talk about. There's going to be health plans or health coverage. There's going to be qualified retirement plans. So think 401ks or IRAs or something like that. And then the third main topic is going to be equity compensation. As a startup, one of the main advantages you have is you can offer your employees equity that other employers may not be offering them, right? So that first category, health insurance or health benefits, doesn't necessarily have to be insurance. We can get to some of these that are not insurance. But this first one here is, as an employer and part of the Affordable Care Act, what was created was this Small Business Health Options Program, or SHOP for short. And what SHOPs are intended to do is allow small employers to offer employees a choice of qualified health plans the same way large employers can, right? Giving the small employer and its employees larger bargaining power through a bigger risk pool. So a bunch of small employers can shop at the shop, right? And it creates more choices for them. The caveat being that you have to be a qualified employer to participate in the shop, and that generally means you're a small employer. Different states have different requirements, but it's either less than 50 or less employees or 100 or less employees, but you have to be a small employer, right? You have to offer participation to all of your full-time employees. And then you can either do it one of two ways. So if you're only located in one area, what you can do is you offer all of the employees in that service area coverage through that state's shop. If you have employees in multiple states, you can offer the shop coverage in the state that they're in, even though you may be located in a different state. So it works both ways. You don't have to have it just all in the one state you're in. So that's the shop, very high level. That's what that's involved, is allows small employers to go to the market like a large employer and shop for health plans for their employees. So what that final bullet point there I have is employers participating in shop can qualify for the small business health care tax credit. And what that does is allows employers that offer health insurance coverage to their employees to take a tax credit. So now we're saving the employer money, right? Or that my first example was how the employee saves money. This is a tax credit for the employer. Another example of how these are more accessible than you may think. But this tax credit of up to 50% of the non-elective contributions made towards the premium cost. So if you're, as an employer, are you making premium contributions for the employee's coverage, you can take a tax credit of up to 50% of that. And I should have said this at the beginning, feel free to jump in with any questions. I'll have a time period at the end for questions, but if something piques your interest, don't feel the need to wait till the end. Jump in, ask the question. So I'll pause here if you have any questions on the shop. Otherwise, I'll move on. So the next slide. So that was traditional health. I mean, the shop is literal traditional health insurance, like as you may think of it. We all pool our premiums together. Some of us are going to get hurt. Some of us are not going to get hurt or sick. And we pay for the people that got hurt or sick, right? That's traditional health insurance. Health reimbursement arrangements, or HRAs. So what an HRA is, it's an employer-funded arrangement that reimburses employees for certain medical expenses incurred by the employee. And this is generally done through an unfunded account. So the employer sets up an account, sets aside money, and says to the employees, hey, if you come to me and you have incurred medical expenses that are not covered by insurance, I will reimburse you for your hospital bill, for example. And usually employers set a limit, like $5,000 a year, I'll do this. And before the ACA, these were fairly common. And the tax benefit to the employee is that the benefits paid from the HRA, so that $5,000, or I should say the $3,000 in my first example, right? That $3,000, if that's HRA reimbursements, those are not taxed to the employee. So traditionally, HRAs were only funded by employer contributions, and they could not be used to pay for health insurance premiums. So the reimbursement was truly for medical expenses, like a hospital bill or going to see the doctor. You couldn't use HRAs to pay the employee's share of a premium for health insurance. Affordable Care Act was passed in 2010. And a lot of the Affordable Care Act rules, for way beyond the topic of today's discussion, basically made HRAs impossible to offer. So then that really kind of hurt small employers, and small employers were really a lot of the employers offering HRAs. Then in 2014 or 2015 or so, right around there, is about a few years after Affordable Care Act, Congress recognized that small employers preferred HRAs, right? They couldn't often, even with the exchanges that the Affordable Care Act provided, they couldn't afford to provide health coverage. So they created a qualified small employer health reimbursement arrangement, that the first bullet point here. And what that allowed was small employers that are not subject to the ACA, so less than 50 employees. So recall it, ACA says if you have 50 or more employees, your ACA requires you, it's called the employer mandate. It was all across the news at the time. It requires employers with 50 or more employees to provide coverage to their employees, or essentially pay a fine. The pay or play provision is what it was also called, right? Well, then the small employer, this qualified small employer health reimbursement arrangement came, and it allows small employers who are not subject to the ACA requirement to offer a health reimbursement arrangement to their employees. It must be offered to all full-time employees. And unlike a traditional HRA that I mentioned earlier, the qualified small employer HRA can be used to pay for premiums. So if you offer, you're a startup employer, right? And you offer a qualified small employer HRA, what their reimbursement can be for is your employee goes to the exchanges and purchases their own health insurance, or even purchases health insurance on their spouse's employer's coverage, right? And you can reimburse them for those premiums paid. And then the employer doesn't have to have any outlay to contribute to the HRA. And again, those dollars are tax-free dollars to the employee. And then in 2017, Congress enacted what's called an individual coverage HRA, or an ICHRA. Some people call it an ICHRA. This is a little different than the qualified small employer in that it's available to employers of all sizes. You don't have to be a small startup. You can be a large publicly traded company. You can offer an ICHRA. There's more flexibility in determining who is eligible for an ICHRA. And unlike, I should have said for the qualified small employer HRA, You're limited to $5,450 in 2022 contributions to a single employee. If they have family and coverage, you can bump it up to $11,000. But conversely, for the individual coverage HRA, there's no contribution limits. So employees can go purchase their health insurance on the exchanges, come to you as your employer and say and substantiate that they purchased this coverage, and you can reimburse them through this HRA. And that reimbursement's not taxed. So they essentially get tax-free health coverage, right? Any questions on health reimbursement arrangements? So
Jordan, on those HRAs, when do they get like a discounted price on those too? Do they work with somebody to get the HRAs? Like at the startup company, do they work with a company that like sells that, or how, and then do they give them discounted prices, or?
Yeah, so great question. So administratively, or the administrative cost of setting up an HRA, it's basically all on the front end. So you'll want to have some kind of plan document. You set the rules around who's eligible, how much you're going to contribute per year. Once you get that going, and you can use an attorney, you can use a benefits consultant, may have some of these documents, right? But once you get that going, the only really the cost is just administering it in the five. If you, like, for example, if you say it's $5,000 limit a year, that's your cost per employee, right? There's not really other ongoing costs like a health insurance coverage, right? Health insurance coverage has premiums, and then you have to go out to the market and shop around and things like that. HRAs are literally just reimbursement arrangements between employee and employer, not terribly unlike travel reimbursements, right? I substantiate my plane tickets. It's the same thing. I bought health coverage on the exchange. Here's my proof I bought the coverage, and the employer reimburses them. And that reimbursement's tax-free.
Okay.
Can that work for a self-employed owner that doesn't have any actual employees?
Self-employed, that is a good question. I unfortunately do not know that. I don't know that the qualified small employer, and I'm thinking, I don't think ICHRA's either. I think because the way they define the employers is I for sure know it's the qualified small employer, no, because the way they define small employer is between 2 and 50 employees. So meaning if you're only one by yourself, they exclude you. What I'm hesitating on is the individual coverage HRA, and they don't have employer size limits, but I'm not sure if, oh, my lights just went out. I'm not sure if they allow for self-employed. That's a good question. Let me get back to you on that if I can.
Great.
Any other questions? So that's health insurance and health reimbursement. So again, main point to take away, there are options that are more accessible and cheaper than you may think in providing some sort of health coverage to your employees, even as a startup. So I'm going to transition away from health and go to the second of the 3 main pillars to talk about today, and that's qualified retirement plans. And I have different ones listed there, right? 401k plans, simple plans, and simplified, not to be confused with simple plans, simplified employee pension, or SEPs. So 401k plan, if you've ever worked at any small or medium to large size employer, probably had a 401k plan. And you may, if you've had that past experience, you may have participated in a 401k plan. So what a 401k plan allows is 2 things. One is it allows for employees to contribute their own dollars, their own salary to their retirement savings, right? And they can either do that with pre-tax dollars or what are called Roth contributions. Roth contributions go in after tax, and they grow tax-free, and then they're distributed tax-free from the plan. Then the second one is employer contributions. Employers can have a myriad of different types of contributions, and 401k plans are comparatively flexible compared to the next 2 I'm going to talk about, and how you want to design your employer contributions. You can do match. So for example, you match if an employee contributes 4% of 4% of compensation, employer will match up to the 4%, right? You can do just a profit sharing. It's called a profit sharing, where you contribute a dollar amount. It doesn't matter how much an employee puts in. There's all kinds of different ways you can design these things. And that's kind of the benefit of a 401k plan compared to the next two I'll talk about. They're more flexible in their plan design. Conversely, what that means is they're generally more expensive to set up and administer year to year. A 401k plan involves a trust, right? So employees' contribution and employer contributions literally go to a trust. And this trustee is holding this money because it's no longer the employer's money. There's annual reporting requirements for the DOL and ERISA. And there's other just annual costs. So you have to have a trustee, you have to have a record keeper generally. It's more expensive to maintain a traditional 401k plan. But theoretically, they're available for a startup, right? The next two are much more accessible, and it goes with the main theme that these benefits are more accessible and cheaper than you may think. So a simple plan, and there's two types of simple plans. There's a simple IRA and a simple 401k. And the main difference between the simple IRA is, as the name implies, the employee goes to their bank or their financial institution of choice, sets up an IRA, and you contribute to it, and they get to contribute their own money to it, similar to a 401k. Simple 401k is the same concept, except that, like a traditional 401k, it's with the employer. The trust is with the employer. The difference between a traditional 401k and a simple plan is that you only have two types of employer contributions. You can either match up to 3% of employee contributions, or you do a straight 2% of compensation. Doesn't matter what employee puts in. And because you only have those two design choices, it's cheaper to set up. There are standard documents. In fact, I'm pretty sure the IRS publishes the document. You literally just you can go on the IRS website and get a simple 401k plan document and download it and fill it in, handwrite it in, and have a 401k plan basically. Excuse me, my phone's ringing. And there's no annual reporting, so it adds to this concept of cheaper. And then the last type to talk about is in a simplified employee pension plan. So this, again, employees go set up their IRA, and you as employer contribute to it. It's different than a simple IRA in this fact that the employee does not contribute to this. This is purely just employer contributions going into an IRA that an employee sets up. Pause now for any questions on qualified plans. So there's a couple tax credits to talk about, right? Keeping with the theme that this is cheaper and more accessible than you may think. So as a small employer, there is a credit available to you for setting up a retirement plan, because again, Congress and the IRS want to incentivize people, both employers and employees, to save for their retirement. It helps all of us in the long run, right? That if we have retirement savings. So they put many things in. Some of those things were the 401k plans, the simple IRA plans. They incentivize you to contribute, because those dollars can go in pre-tax today. And that goes back to the tax illustration I first showed, that if I pay less tax today, I have more take-home income. Or if my employer gives me tax-favored benefits, I have more take-home income, right? So to the tax credit, so expense in setting up, let's say, a simple 401k plan. The credit for small employers allows you to receive a tax credit for the costs associated with establishing and administering a retirement plan, which could include a simple plan. And the amount of the credit is the lesser of $250 per person that's going to be eligible to participate in the plan, or up to $5,000. So if you start a simple 401k, which are incredibly cheap and easy to start, you can get a tax credit of up to $5,000 just for starting it and having it available for your employees. And then there's a tax credit for employees, right? So the second bullet point there, retirement savings contributions credit for certain income eligible plan participants. So the employees participating in the plan. And what this is a credit of up to 50% on the first $2,000 contributed by the employee to a plan. The credits in addition to the tax savings that they have on their own deferrals to the plan. So it's a potentially very valuable credit to the employee. The downside is that, or I should say the downside, the caveat being that it's not, I have the certain income eligible plan participants. So this credit begins to phase out if you're single taxpayer at $20,500 worth of taxable income, and completely phases out at $34,000 worth of taxable income. If you're married filing joint, those numbers are $41,000 and $68,000. Any questions on qualified retirement plans and how you can offer them to your employees? So now is the third pillar. We talked about health, we talked about qualified retirement. Now we talk about incentive compensation and mainly equity, because equity is one of the key ways startups can differentiate themselves. So if you have someone who's weighing a job offer from you, or weighing a job offer from established medium to large size employer, the main way you can differentiate it is with equity. Come join me. We have a growing company. I will share the growth with you. Generally, they're not going to get equity at their other employer, right? And this is really where the fun begins, because now we can start talking stock options and restricted stock and things like that, and how we can incentivize people. So on the slide here, I have the bolded ones, the three main points: equity, phantom equity, and just regular bonus, incentive bonuses. And the intent of all of these is to align the employees' incentives with the growth of the company. I give you stock options, they're worth X today. You work really hard and make the value of the company go up. It's going to be directly tied to your compensation at that point, right? If you have equity. So I'll first start talking about equity. And there's three, within equity, there's three main forms. There's stock options, and stock options come in two flavors. There's incentive stock options, and there's non-statutory or some people call them non-qualified stock options. Really what they do, fundamentally they're the same. There's a stock option. A stock option means I as employer give you as my employee a option to purchase a share of stock in the company. And I'll pause here to say, I'm using the term stock. You can have, if you're a partnership or an LLC, you can also have options. I'm just going to use the word stock though, but bear in mind that you can have this if you're a partnership. But going back to the example, I, employer, give you one option to purchase one share of stock. And if my stock is valued at $1 today, now they hold this option, and they're directly incentivized to make the value of the share go up as much as possible, because in the future, when they exercise, they only exercise for $1. So for every penny above $1 that the share value grows, they get to keep that. And that's how we directly incentivize them to grow the value of the company. The difference between the two flavors of options, incentive stock options or non-statutory stock options, it depends. It gives them, the recipient, different tax treatment. So non-statutory stock option, when they exercise it, they have ordinary income, wages, on the spread between the value of the share when they exercise over their exercise price. Incentive stock option doesn't have that. They're not taxable when they're vested. And then fast forward to some kind of sale event, or when they ultimately sell the share, the employee gets capital gains treatment on all of that. And as you may know, capital gains rates are much less than ordinary income rates in general, depending on your tax bracket, right? Restricted stock, the next category. Restricted stock are different than stock options. Restricted stock is an actual grant of a share today. Here's a share. The caveat being it's called restricted because if you leave before I say you're vested in it, and I either say that's a time period, or we can tie it to performance, like you need to have X in number of sales, or the stock price has to hit a certain value, anything we can really ever dream of. And this is where the beauty of equity comes in. We can get pretty flexible in how we design these things. Especially restricted stock. And I give you one share, it's restricted now, but I'm giving it to you. You don't have to pay for it. Unlike a stock option, you have to pay an exercise price, right? I'm just giving you a share. It's full value. You have the full value of the share, and every effort you impute to the company that increases the value of the share, you get to keep now because you have equity in the company. Provided you vest. Again, that's the restricted part of it. So that's the difference between stock option. Stock option has an exercise price. They have to pay, basically pay to play, right? Pay the exercise price to get a share. Whereas a restricted stock, you just give them the stock. And then this next category, capital versus profits interest. And these are partnership concepts, or an LLC, if you're an LLC taxed as a partnership. And the difference between a capital interest, essentially a capital interest is like a restricted stock, but for partnerships. Like I'm giving you a share of my partnership today, right? A profits interest is slightly different. I'm giving you a share of the partnership today, but it's only a share in future growth from today. So if the company's sold tomorrow, you don't get a share in any of that. You only get a share in the value appreciation of today forward if you have a profits interest. But it is actual equity. They're your partner. Legally speaking, they're your partner. And those are the three main types of equity. Next broad category is phantom equity. So unlike equity, where we just talked about, they're going to be your partner, they're going to be your fellow shareholder, they have legal rights in that regard, right? If you give them a share, they're going to have legal rights in being a shareholder. Phantom equity says, I will compensate you as if you were an equity holder, a shareholder, or my partner, but you're not actually my partner. You don't actually own any equity in the company. And there's a couple ways we can do this. Oops, didn't mean to do that. Appreciation rights. So appreciation rights are essentially stock options just with phantom equity. Or stated another way, they're a stock option that's settled in cash. So an appreciation right has an exercise price. The value of the share today, I give you one appreciation right. And when you exercise it down the road, you get to receive in cash the spread between the value when you exercise versus the today when I gave it to you. So it's an appreciation right, or thought of another way, it's a stock option settled in cash instead of settled in a share of stock. A restricted stock unit is unlike restricted stock. A restricted stock unit is a promise today to either give you in the future a share or cash equal to the value of a share. So if you give me 10 RSUs today, I'm your employee, you give me 10 RSUs today, the contractor, the agreement's going to say, when you vest 2 years from now, let's just say 2 years, it can be any time period you really want. 2 years from now, I'm going to give you 10 shares because you have 10 RSUs today. And so the more you make the value of the share go up between today and then, is the more you receive in compensation at that time. And they can be settled in shares or they can be settled in cash, making them phantom equity. Again, before they settle, and only if they settle in shares, they're not a shareholder, right? They only have these phantom equity rights. And the third broad category is just straight cash bonus. And these can be almost any flavor you want as well. So the first one I have there is like a retention bonus. If you're still here in 3 years, I'll give you a bonus of X dollars. It can be as simple as that, right? It can be even, we can design these kind of however we want. We can design them to be more like phantom equity, where we say, if you're still here in 3 years and the value of our share is X dollars, I'll give you Y dollars, right? But the intent of a retention bonus is that retention hook. Hey, stick around, stay with us, and I will reward you for staying with us. Retention bonus. Another one is a change in control bonus or a liquidity bonus, right? Hey, we're a startup, and if we ever sell, if we grow and we make ourselves attractive to buyers or investors and we sell, I will share the proceeds of that sale with you. That's a change in control bonus. So if we sell for, let's just get crazy, $100 million, right? $100 million, I'll set aside 5% of that for you, and you get a 5% change in control bonus. So here's $5 million. That's what a change in control bonus does, right? It's similar to phantom equity in the sense that it is somewhat tied to the value of the company, but it's just simply paid in cash. There's no equity actually involved. So that's why I have it in the bonus category. Any questions on any of these? These are really how you can start to differentiate yourself with other employers and how you incentivize. And then the other way that you use these, not only to differentiate yourself and make yourself more attractive, you can use these if you want to target certain behaviors. So if you want to target more sales or something to that effect, you can grant them equity, and they can only vest if they hit a certain number of sales goals, right? So you can, certain behaviors you can target through these incentives. So this next slide I have is issues to be aware of, just broad issues to be aware of with incentive compensation. So one of which, the first one I have there is dilution. And got to be aware of two forms of dilution, one of which is economic dilution. So if I'm giving out, if my company has 1,000 shares, I have all 1,000 to start with, and I give my employee 100 stock options, I've potentially diluted myself 10% of the economic value of the company, right? The other dilution to be aware of is voting rights dilution. This is less to be aware of than, because normally we wouldn't design something to give someone else voting right power more than you, but it's something to be aware of. If you start granting equity out, you made a lot of awards early and you want to hire someone new. Well, maybe you made a lot of awards early and now we've kind of run out of room to be giving more people. It's something to be aware of when you're issuing these things. And then there's three. When investors now come in and they're going to give you X dollars for Y% of the company, and you've already given some employees another % of the company, it's all kind of working together. And this is one of the things when the investors or the private equity come in, right? They hire the attorneys like me, and I look at these things. So what is the dilution table right now? What's the cap table look like? What are we going to be looking at after this? How many people have equity? Things like that. The second bullet point there I have is tax deductions. So that previous slide where I listed the different types of awards, as an employer, those awards have different tax consequences to you as well, not only to the employee, but to you. And certain awards, for example, incentive stock options, do not give you a tax deduction for the compensation paid to the employee. So you lose out on that. Other awards, you still get the tax deduction, like non-qualified stock options or restricted stock options. The amount that was given or conveyed to the employee, that is going to be included in their wages. And so you, in return, get a deduction for compensation paid to your employee. Sticking with the tax theme, capital gain versus ordinary income. So this is now transitioning away from the tax on the employer side. It's the tax on the recipient employee side. Certain awards grant capital gain rates before others. For example, again, incentive stock options versus non-qualified stock options. Other awards, for example, phantom equity, have no way of having capital gain. That's always going to be, especially if they're paid in cash, that's always going to be ordinary income, wages, right? That's wages. You might as well have just paid them a bonus. And then the final thing I have on this slide is code section 409A or 409 cap A. Is the elephant in the room whenever we're talking about incentive compensation or equity compensation. If you've not heard of 409A cap A, it's the tax code that Congress enacted as a result of the Enron scandal. And so what it effectively says is we cannot accelerate deferred compensation. We cannot delay deferred compensation any longer than the time period set forth in the agreement. And if we do, there are some stiff tax penalties. And if you recall Enron, what happened with Enron was the executives knew Enron was going down. They had these deferred compensation arrangements, and they called them all in, said, pay me now and not pay me when the agreement says to pay me. And then Enron collapsed. And Congress didn't like how that looked, didn't look good in the national media either. And so they enacted 409A. And so it touches almost on all of the prior slide, whether we're talking stock options, stock appreciation rights, retention bonuses, we have to be cognizant of 409A. And that is my presentation. I know I went through a lot. I hope I didn't speed through it too fast. Any questions on any of that? I mean, that I know it depends on, also kind of depends on your life cycle, right? I mean, are you ready to hire an employee just yet? Are you thinking of hiring employees, or have you hired an employee and you're thinking of offering employee benefits? So any and all questions are welcome.
No questions?
Let me stop sharing here.
There we go. So no questions for Jordan.
I did perfect.
You did,
That's
yeah,
right.
you made complete sense, right? So with some of those, the equity that some of the startups get, I know, like I said, when I was working for some startups, I had some equity. I know there again, a lot of it is like with vesting, you have to be there a certain amount of time. You know, now that you can't change that on people, can you? Or does that ever happen to where, like, you know, I don't know. I mean, sometimes I know you hear people get kind of burned on that sometimes.
So from the employer perspective, startup perspective, you can always accelerate vesting. So if originally, let's just keep it simple. Originally, it said you have to be here 3 years and you vest in your stock options. You can always accelerate that vesting. You can say, okay, we're changing it to 1 year. What we can't do generally, because the agreement says otherwise, can't delay vesting. The other option that you have is, speaking of the change in controls or the sale transactions, you can provide in the agreement some protections to the employees or to management to say, hey, if the buyer comes in and terminates you without cause, right, involuntarily terminates you, we can accelerate your vesting as well. So it protects the employees that way. So you can always accelerate it, but you can't generally delay it.
Okay.
But vesting is one of the main discussion terms when I'm setting these up with clients on what their vesting strategy, because that goes into how are we incentivizing them? Are we wanting more of a retention hook? Do we want it strictly time-based? So in other words, you're still here, my employee, you vest. Do we want some kind of performance angle on it tied to, like I said, this is where you get into how are we incentivizing certain behaviors? If we valuing this certain type of sale or targeting these type of clients or things like that, then you can design it to fit your needs, basically. And that's that we spend a lot of time on vesting.
Yeah. Makes sense. Well, if there's no other questions, I guess we can, you know, thanks, Jordan, for your time. Really good information. Peter and Donnie and Quentin, we had 2 other roundtable sessions with Hush Blackwell in June and July. So you can see all that on our YouTube channel if you guys want to go there. And I know Hush Blackwell as well, they've told us they've got a wealth of information, you know, on their website too for different topics and, you know, free information there and ways to get in touch with them if you need any legal advice. So, but thanks again, Jordan, and I'll be following up with you and Julie after the session. So
yeah,
if there's no other questions.
This was fun. I do enjoy speaking on this. I do enjoy helping our clients with this because like I said, to start, this is fun. The compensation aspect of things is fun. It's meant to be fun.
Right. Gotta have fun somewhere. Come on.
Yeah, yeah,
If we all just
I know it.
hard work in business.
yeah.
All right. Well, thanks a lot. And you guys all enjoy your evening.
Thank you. You too. Bye.
All righty. Bye-bye.